Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. The Canada Pension Plan Investment Board ended its fiscal year with a net return of 7.8%. The increase in assets was boosted by income and transfers from the Canada Pension Plan. Returns were helped by holdings in public equities and real assets. The results fell short of CPP's benchmark portfolio, which returned 13.2% for the same period, boosted by heavier exposure to large tech companies. And we'll find out more when Amanda Lang speaks with John Graham, President and CEO of CPP Investments. You can watch that interview on Taking Stock Friday at 3 p.m. Eastern. Shares of Lightspeed Commerce are taking a hit. Look at that, down 6.7%. That's after the point of sale and software provider posted profits for its latest quarter that missed estimates. Adjusted earnings also came in lower than what analysts were expecting. In addition, Lightspeed's revenue outlook for its current quarter, along with its fiscal 2027 goals, also missed the mark. NVIDIA beat expectations for first quarter profit and revenue and also boosted its sales forecast for the second quarter. The chip giant has also authorized an $80 billion U.S. share buyback and raised its quarterly dividend. The results indicate an attempt to diversify NVIDIA away from giant data centers, with CEO Jensen Huang emphasizing the significance of physical AI, including robots and automated vehicles. And a quick look at the markets. The TSX, after starting the morning in the red, has turned things around, at least for now. It's up by about 0.2%. South of the border, it's a little bit all over the place. Now they're back down again. We saw a couple of greens in there briefly, but disappeared. The S&P 500 off by 0.36, and the Nasdaq's down by a half. And oil prices are higher this morning as investors wait to see whether talks between the U.S. and Iran will translate into a tangible peace deal. Our next guest says resolutions to the conflict would be a short-term negative for oil prices, but he is still bullish on Canadian energy over the medium term. Joining us now is Benjamin Klein, Senior Portfolio Manager at Baskin Wealth Management. Benjamin, thanks as always for joining us.
Thanks for having me.
Short term, we saw a little bit of a short term for a couple of days there. The oil started dropping. Now it's bounced back a little bit. Where can you even make a prediction where you think oil is going to go over the short term right now?
I think the obvious answer is, unless you know what's going to happen with the war in Iran, I don't think you can. Obviously, that's, to say it's an elephant in the room is probably an understatement. It'll depend on how this war escalates. If it gets closer to the end of the tunnel than it is now, this could last a day, a month, a year. The degree to which it continues to escalate or de-escalate is anybody's guess. Obviously, if things do move towards a resolution and a reasonable one that results in an end to hostilities, you could see oil prices calm down. Obviously, there will be an adjustment period before that happens, as supply catches up with demand. But the short answer is not really.
And if this does drag on, how important is it the fact that countries are drawing down hugely on their reserves?
Clearly there's a limit to how much is out there. I don't think there's really much risk in the short term of countries really depleting or putting a significant enough dent into their reserves to have a global impact. For Canada, we think this is probably a positive, at least in theory. Whether or not there's a resolution in the very short term, we're pretty bullish on Canadian energy in the medium term. We know the government is working to accelerate investment in infrastructure. Countries, particularly in North America and Europe, want to diversify energy suppliers. And we think in terms of valuations are very reasonable, even if WTI comes down to the 70s or 80s a barrel. And
it's definitely it's Canada's now. It's on the radar. Is it going to stay on the radar for other places, Europe, for example, and as a source?
I think so. I mean, to some degree, it depends on Canada's ability to expand production and expand infrastructure. But certainly, if there is headway made in that area, then I see no reason why it wouldn't be.
And I guess, one of the big things, Ottawa and Alberta signed that deal, but the stumbling block is what's in between Alberta and the ocean. That's BC. Yeah. Do you see that being resolved? and we actually see a pipeline?
I mean, hard to say. Obviously, there are two pretty vocal groups on either side. It would probably be good for Canadian on a baseline oil level. Obviously, there are environmental, and land concerns. Hopefully, there's some ability to come to a compromise and appease both sides, but only time will tell.
And going the other way, if we want to attract Europe, do we have to go through the States to get our oil there, or do we need a pipeline from going east as well?
Very possible. It's really not all that far, all things considered, across the Atlantic. It would be a huge boon if the infrastructure could be built, if the capital could be allocated. I mean, I don't know what the chances of that happening are and how long it would take. But if it happened, I think it would, be hugely beneficial for both parties.
And when you're talking about being bullish on the Canadian oil industry, medium, what's medium to you? And what would it take for it to make it long term, bullish long term?
I would say probably over the next 3 to 5 years. It's infrastructure when the will is there. It can be built relatively quickly. Who knows what's going to happen in the oil industry over the next 10 years? Obviously, with the development of much cheaper solar and administrations in the U.S. being perhaps more or less inclined to invest in clean energy. So obviously, over the longer term, there are much more many more uncertain variables. But in the let's say the next 5 years, there are a lot of opportunities for Canada to capitalize on of course, the horrible war in Iran, but it could potentially be a benefit to Canadian oil.
And you feel it's across the board in the sector?
We think so. Canada obviously has a lot of natural resources that we can draw on, whether it's natural gas, whether it's oil, and the ability, at least in theory, to get that oil and gas to places that need it. So we think that there's a lot of potential upside. Still obviously question marks, and the things have to get done. But if they can be done, then it can be a significant positive to the Canadian economy.
I just want to come and back into the short term. Even with the oil prices where they're at, we're still functioning. Can we continue or is an impact eventually going to be felt?
We're already seeing some impacts. Walmart has said in their commentary that inflation has already impacted consumer spending. That's, I think it's obvious that more inflation is going to dampen consumer spending, and maybe not quite as obvious to your everyday consumer how much fuel prices impacts the cost of particularly things like food, a huge amount. In fact, in a lot of cases, the majority of the cost of food is actually getting the food to the place where it's sold. So, it's really just a matter of time, in our opinion, how long it takes for those impacts to continue to be felt, not just in prices, but in consumer spending as well.
And if the war in Iran drags on, everybody waited for oil to hit 150. We heard that talked about. Does that become a possibility if it drags on?
Sure. It depends. If it's 2 years from now and we're still dealing with the fallout, or still, the war is actively going on, and if reserves have been drawn down, and if, there are other impacts that make it more difficult to move the oil around, and if the demand continues to climb, sure. I don't know that I'd put my money on it, quite frankly, but the's no reason it couldn't happen.
All right. Let's hope not as well. And just one last question. I want to get your thoughts on NVIDIA. I think it's safe to say stellar performance, and yet the markets are indifferent.
Yeah, this is, of course, one of the best companies in the world, and we don't own it, but absolutely fabulous company, and the profits are unfathomable, quite frankly. They're obviously priced at a level where they need to be pretty much perfect, and for the last several years, of course, they have, to their credit. I think the market is worried about a few things. Number one is the potential that they do eventually lose market share to custom chips like Google TPUs, Amazon Trainium, other potential custom chips. I think it's worth noting, and this is maybe a little bit surprising about how the market is reacting. With their new reporting framework, they are showing that they actually are less reliant on hyperscalers, because they've split out their revenues into two different sectors, and they've seen significant growth from AI cloud computing, for example. So we think the earnings have continued to be phenomenal. Obviously, there are risks, like with every company. A little bit surprised that the stock market reaction has been negative, but to some degree, it's in the short term, it's very hard to get a sense of what the market wants, particularly when you beat earnings, but the market wanted an increase to guidance or something like that. If you're a long-term investor and you saw those earnings, I think you would be pretty happy.
Okay, we'll wrap it up there, Benjamin. But thanks as always for joining us.
Thank you.
Benjamin Klein, Senior Portfolio Manager, Baskin Wealth Management. Coming up, today's market drivers with Bloomberg's Monique Molina. Time to take a look at today's market movers, and for that we are joined by Bloomberg Equities reporter Monique Molina. Monique, thanks as always for joining us, and let's get right to it. Not a boring topic, drilling. The company's name is BOR, but it's BORR. I'm fascinated by that. What's going on there? They had some issues.
Yes, so BOR Drilling, they reported their first quarter results today, and the net losses were wider than expected and also wider than their losses a year ago. And that's why we're seeing a big decline in shares. The company reported that their Odin rig had some delays to start up, and that's what weighed on their earnings for the quarter. And those delays are also expected to continue into the current quarter. So that's why we're seeing a lot of pressure on the shares today. Analysts say the results were somewhat mixed. Revenue did beat, but they say investor focus is really on the outlook for this company, with the concerns about the rig delays, as well as when they're going to be able to realize some of the benefits from higher oil prices. The company said that they won't see impacts to higher activity or higher rates until about 6 to 12 months after the rise in oil prices. So they're not expected to see some of that boost from increased North American oil demand for quite some time. So analysts are really hoping to see the rig start up soon.
All right, Critical Metals is going to Greenland.
Yes, so Critical Metals, their shares are higher this morning. They have a large heavy rare earth deposit in Greenland. It's one of the biggest in the world. And they announced this morning that they reached an offtake agreement with Realloys. This company is going to be buying about 15% of the Critical Metals rare earth concentrate in this deposit. And this is really positive for the company. This means they already have agreements in place for the sale of some of these assets. And this is a 15-year agreement. So this also provides more of a longer-term outlook for their sales for investors. So we're really seeing some rising off of that, and also just off the increased demand for rare earths, particularly as people are looking at supply outside of China.
All right, finally, Intuit is taking another hit, I guess would be the way to say it.
Yes, so Intuit, their shares are down this morning. They reported their third quarter results that had quite a miss on their TurboTax revenue. This came in lower than expected, and analysts were also expecting a bit more positive results in TurboTax because of previous company commentary. They also note that there's some concerns that maybe there might be some AI disruption fears, specifically to their tax businesses. Their shares are also trading lower after the company announced that they would be laying off 17% of their staff. They say this is for cost-cutting reasons and also for them to focus more of their own investment into AI. But with such large company layoffs as well as the miss, we're really seeing the shares hit lows that they haven't seen in terms of the drop for decades.
Okay, Monique, thank you very much for that. Bloomberg's Monique Molina. Up next is NVIDIA, a buy after its blowout quarter. We'll get some insight after this. Well, NVIDIA surpassed first quarter Wall Street expectations on massive demand for its AI chips, but reaction from investors rather muted. Let's find out why investors might be so skeptical. Joining me now is Gil Luria, Head of Technology Research at D.A. Davidson. Thanks as always for joining us, sir. Why the muted response? Let's just get that out of the way now.
Yeah, that's been the pattern the last few quarters. It doesn't matter how good NVIDIA results are. The stock, it doesn't necessarily react positively to earnings. A big reason for that is that we actually knew that NVIDIA would report this type of result a month ago, when Microsoft, Amazon, Google, and Meta reported. Those companies drive more than half of NVIDIA's revenue, really. And so we knew that as those companies continue to spend on CapEx, continue to increase CapEx, NVIDIA would do well. The stock is up since then, which tells you that that was reflected in the stock. And today they just delivered the formality, or last night they delivered the formality. But mind you, very good results. Beat, raise, staggeringly high numbers. They talked about selling 20 billion of standalone CPUs this year. That was zero last year. So their opportunity continues to grow. There was nothing bad about last night's result. It was all good. It's just that investors already knew that was coming.
Okay, so 90 billion, exceeding 90 billion for their revenue for the next quarter. Is that achievable? You just mentioned about that 20 billion. So is that achievable then?
Yeah, and in fact, over the last few months, the company's given us much more visibility than in the past. They've talked about $1 trillion cumulative business for Blackwell and Rubin, which means that they can continue to grow at these rates well into next year. And that's something that as investors get more comfortable with, they'll appreciate NVIDIA more. NVIDIA is already trading in the low 20s on forward earnings. It's unlikely that they'll trade at any less than that next year, and their earnings will be at least 50% higher. So that's why this is such a good setup for NVIDIA. They have more visibility than ever, and the stock is trading at the very low end of its historical multiple range.
All right, and you mentioned Vera Rubin. What makes it so unique, and is there anybody even threatening it right now to compete with it?
It's just much more performant in the sense that you can get a lot more tokens per dollar, which ultimately is what is important for AI, both mostly on the inference side, is what does it cost you to create a token, to drive AI, and their products continue to stay ahead of the competition. All AMD and Broadcom and the proprietary chips from the hyperscalers can do is try to keep up and at least for some applications have a slightly lower price point because NVIDIA is just much more performant with every generation of new semis that they introduce, new GPUs, and again, new CPUs as well. So they're staying ahead of the competition, and that's really the story of Vera Rubin, is that by the time the other chips catch up to Blackwell, NVIDIA shows up with Vera Rubin.
And with that, can AI replace these chips? Could somehow NVIDIA be replaced by AI?
Well,
I went on a tangent there for a second.
All of us.
I went on a tangent for a second.
Can replace all of us. Yeah.
Go.
Yeah, NVIDIA doesn't actually own its manufacturing plants. If you distill what NVIDIA does, they make a very complicated design file that they send to TSMC in Taiwan to manufacture. So could at some point AI be so good that it can design a better file and do that instead of NVIDIA or for NVIDIA? That's possible. But again, at that point, none of us have a job anyway, so we won't even have to talk about it.
Well, you and I are sitting on a beach then and talking about this, hopefully. Other competition, China. Do they need to crack that market, or are they going to be good without it?
Well, it's a quarter of the global market, so they very much would like it to be part of their market long term. In the short term, they're just caught in this back and forth between the US government and the Chinese government about whether they can sell even degraded last generation chips. And at some point, the US government agrees and the Chinese don't, and then the Chinese don't agree and the US does. So it's been just back and forth for several months. Right now, none of us have Chinese sales in any of our NVIDIA expectations, but longer term, they do want to participate in the market. Again, it's a quarter of the global market.
And are the Chinese chips closer, getting closer?
They're getting closer, but it's the same thing. NVIDIA runs so fast that as the Chinese catch up to the last generation, NVIDIA comes up with the next generation. But they will address the domestic need in China because NVIDIA has been shut out of that market, and that helps them grow to scale and get better. And that's what NVIDIA doesn't want, is that it doesn't want this to be making Chinese semi companies better and bigger and then using that leverage to sell outside of China. That's why NVIDIA wants to continue to sell even degraded chips into China in order to prevent the Chinese industry from developing to a point where they are competitors on a global scale.
All right, and NVIDIA, they're trying to diversify, and how important is that?
Yeah, so NVIDIA really controls the whole ecosystem. They're really the orchestrator of the great data center build out. They have had this foresight about how quickly it would come to be. So they've coordinated with TSMC in making the chips, with the memory companies, Hynix, Samsung, Micron, for delivering enough memory. And then they quietly decided that they're going to sell CPUs on a standalone basis because they anticipated that using AI in an agentic manner would require a lot more CPUs. They have networking equipment. They're working with the optical companies. They're the ones orchestrating the whole build out because they have all this foresight. And that allows them to participate in the most significant way and be in the middle of the build out, which means in the middle of the AI trade.
All right, and you still have it as a buy at $300 US.
That's right.
And no changes.
Not until they get over 300, and then we'll have to reassess.
All right, we'll leave it on that note there. Gil, thanks as always for joining us.
Thank you.
Gil Luria is head of technology research at D.A. Davidson. Coming up, since Donald Trump's 51st state threats, many Canadians have actively boycotted U.S. products and vacations, but can they do the same when it comes to their investment portfolios? That's right after the break. Shares of Stellantis are under pressure in today's trading after the automaker unveiled a $70 billion turnaround plan. The major reset includes focusing roughly 70% of investments on key brands, including Ram, Jeep, and Fiat. Stellantis will sideline Chrysler, Alfa Romeo, and Opel. The strategic outline also includes a new savings goal and aims to boost profit and raise returns in North America and Europe by 2030. Shares of Walmart are in the red after the world's largest retailer missed its profit forecast for 27. Walmart's operating income for the first quarter also came in below expectations. The retailer says benefits from favorable merchandise and business were offset by higher fuel costs. On the upside, same-store sales and revenue in the latest quarter saw growth, with global e-commerce sales rising significantly. Shares of IBM are moving higher. The American company will receive $1 billion US as part of the Trump administration's investment in quantum computing. The government is pledging a total of $2 billion, with a grant also going to global foundries developing specialized chips for quantum computing. The investment will give the U.S. government a stake in the companies. And a quick look at the markets. Nice little rally continuing for the TSX. It's up by 0.33%. The U.S. markets, though, not going into the green right now. They're still all down. S&P 500 up by 0.37. NASDAQ by about 0.5 point. Donald Trump's tariffs and threats have prompted many Canadians to slash their cross-border travel and consumer spending. But what about their portfolios? Is there a viable alternative in European stocks? Joining us now to discuss the big pivot is Guillaume Touze, President and CEO of Quadra Capital. Guillaume, thank you very much for joining us.
Thank you, Roger. Very nice to have you.
Cheers, we appreciate it. So what's going on when it comes to Canadians? Are we seeing a shift with money going down into the States?
Yeah, I guess we're seeing a beginning of internationalization of portfolios. I mean, we very much believe that maybe 20 to 30% of Canadian portfolios should be invested in Europe, or at least outside the US and Canada. And people have started to move that way, I guess, over the last few years. There's been a clear, I guess, emotional acceleration since the beginning of 2025 for some of the reasons you mentioned earlier. I mean, so why do we think Europe makes sense in particular? I guess, well, first of all, I mean, you showed the indices earlier, and they're coming to the screen right now. Europe is strongly undervalued today compared to U.S. peers in particular. I mean, and the Iran crisis has clearly increased the P differential. We're looking at pretty much the level we were at the back end of 2024, so one of the lowest point historically. So that's for us as an opportunity. Two, I guess the European game is not a game of indices, unlike maybe in the US, where if you're an investor on the S&P 500 and NASDAQ, you are well off for a number of years. Europe is more of a game of stock picking. So if you're capable actually of identifying the right stocks, and I'll give you some examples in a second, and I think you can really make it work in your portfolio. Three, I guess, Europe is the home of some of the world leaders. I mean, leaders in cosmetic, like L'Oreal, aeronautics, like Airbus, luxury goods with the obvious LVMH or Hermes, even obesity treatment with Novo Nordisk, needed by some people probably like me who tend to get a little rounder with the years. And the Iran crisis has accelerated this. We see this very much as an opportunity. You know that Europe has a lot less resources than maybe the United States or other parts of the world. And that creates a tension that we've seen since, I guess, the beginning of March. The beginning of the year, actually, European indices did much, much better than the U.S. counterparts. This has shifted the other way. Might be an opportunity for portfolios for our Canadian investors.
Okay, and with mentioning Iran, could the markets drop more, or if it's not resolved because of their dependence on oil?
No, I don't think the European markets will drop much further for that particular reason. I think they have clear issues of restructuring for a number of companies. Kering is an obvious one. You showed earlier the result of Stellantis. That's another one. But I guess when it comes to the pressure of energy on European markets, I think we've seen most of it. We have to learn to deal with it. And what the Europeans are currently doing, particularly on the electric side, on the new renewable energy side, I think we'll be able to compensate the original stress that we've seen, particularly in March and April this year.
All right, and now you mentioned world leaders, luxury names. But where else? People, I think, sometimes maybe look at it as the old continent, old school. But are there cutting edge areas you feel there are opportunities?
Well, I think if you look at, I mentioned electricity a few seconds ago. If you look at, for example, a company called Schneider Electric, it's a world leader in energy management and industrial automation, focusing on digital transformation. 153 billion market cap, so it's a significant company within Europe. That could be an idea. I mean, Europe has been investing a lot in electrical equipment. Data center demand, as you know, is really, really high. There's a strong pipeline and visibility in this particular field. Notably, the power and grid, set of infrastructure is accelerating. And we believe that's when you look at it quarter on quarter, this is an area where people should be investing more and more. The company in particular, if you look at Schneider, is trading at 17 times multiple. This is a very reasonable valuation. Currently, the price around 260 euro a share, and we aim for 350 to 400 for this particular stock.
All right, and sorry, go ahead, finish, please.
No, I was going to move to the health sector. I did mention obesity earlier with Novo Nordisk, which hasn't been doing that well since the beginning of the year. But when you look at the health sector, you have a Swiss firm called Alcon, which we believe people should be looking at. It's a global leader in eye care, providing surgical equipment, intraocular lenses, and vision care products. Smaller company, 27 billion Swiss franc of market cap, but very much benefiting from growth driver like aging demographics, obviously rising procedures volume, more and more people willing to take care of their eyes in a more sophisticated manner. And this supports, I guess, very strong EPS growth and strong earning visibility in our view. This stock is trading slightly higher at 23 times earning, 53 Swiss franc today. We aim for 90, we believe, in the reasonable short-term future.
All right. And if Canadians want to look at Europe, what's the best way to go about it? We got about 45 seconds.
So I guess they can look at individual stocks and build a portfolio of I guess, key leaders in a number of areas. That's one. I would not buy index products because European indices are very different from US ones. They don't have the Magnificent Sevens, for example. The other way to look at this, in our view, is to buy European funds or international funds who are have a strong focus on Europe. Stock pickers in particular, in my view, would work, as the efficiency of the market are slightly lower, than what you have in the US.
Okay, we'll wrap it up there, Guillaume, but thank you very much for joining us today. We appreciate it.
Thank you for having me.
Guillaume Touze is president and CEO of Quadra Capital. Up next, ATB Financial just released its earnings. We'll talk about those numbers after the break. ATB Financial is reporting record revenue in its latest quarter. The Edmonton-based company saw a boost in performance on national expansion and integrating acquisitions. Here to talk more about that is Chris Turchansky, President and CEO of ATB Financial. Chris, thanks very much for joining us.
Thank you for having me.
I think you have a reason to smile. What drove this record number?
Yeah, there's a number of factors. First and foremost, we have over 5,000 team members who are 100% committed to helping our clients succeed. And we've seen clients really navigate a very uncertain environment. So team members focused on helping clients navigate the uncertainty allowed us to have record results. And we saw that across all of our lines of business, from our capital markets. And you talked about the acquisition of Cormark to become ATB. Cormark Capital Markets was critical. Robust loan growth in business banking, taking market share in our retail mortgage side of the business, and then wealth actually crossing over 40 billion in assets under administration. So a great year from all divisions this year.
And do you see that carrying into 26, into the second half and into 2027? With so much uncertainty in the air, so much up in the air right now?
Yeah, I think if you look back and reflect last year, it was early in the year last year where Trump came out into the Rose Garden and made a pronouncement, which created tremendous uncertainty. You saw the war in Iraq last year create further uncertainty, and tremendous resilience from Alberta businesses, Canadian businesses, really navigating that uncertainty. So our focus this year is how do we maintain that momentum, and at the same time help our clients navigate what's sort of shaping up to be even a more uncertain year with CUSMA and the negotiations coming up, as well as the continuation of the war in Iraq.
And are you building buffers for any potential downturns?
Yeah, I think from our standpoint, making sure that we're well positioned as a bank is critically important. And at the same time that we're there to support clients. If there is a downturn, one of the things that has really been a bedrock of ATB over the last 88 years is being there to support clients through challenging times. So we're really careful to make sure that we're in a great position to support clients as they have to navigate this uncertainty.
And let's talk a little bit about Cormark. How is that going? What do you see as next?
Yeah, so we were really excited. In December 15th, I think, was the final closing date to acquire Cormark. So first and foremost, a great cultural match for us in terms of Cormark, and really complementary in terms of what Cormark, what sort of they provide to clients, fit in incredibly well, and really had a strong fourth quarter in the midst of integration from there. So as we look forward, it's continue, how do we integrate Cormark into ATB Financial? How do we make sure that they're in a position to continue to do the great things that they've done and build on that going forward? We're always on the lookout for complementary acquisitions if that's what comes about. But right now, really the focus is how do we leverage the acquisitions, both Cormark and BCV from just over 18 months ago on the wealth management side.
And are acquisitions getting harder to find in this sector?
Yeah, I think you always, you're open for acquisitions. For us, being a cultural fit is so important, and having this same long-term vision of how do we be there for clients through what is uncertain times and different sort of periods of growth. So finding a company that's aligned to those two things, first culturally and with this long-term view on helping clients, is critically important. So I think you have to be patient and make sure you find the right fit. And when you find that fit, you have to be able to act. And when you act, you then need to be able to execute. And that's the phase we're in right now.
And being Alberta-based, I mean, oil and gas is a big thing. You're used to dealing with things like that. What's it like when you're looking outside and trying to expand, dealing with different industries, different sectors that fuel the different locations?
Yeah, for us, just like a lot of our clients here in Alberta, it's how do you export what you've done incredibly well? For us, the energy sector, as you talked about, has been critical to our success. And what we realize is when you have this deep expertise in that sector and you're able to support your clients with advice and help them navigate and help them grow and achieve their goals becomes really important. So when you look at Cormark, they had a franchise that was stronger in other industries that were not. And it's really that same playbook of having this deep expertise in certain industries. And how do you apply that expertise to help clients achieve their goals?
All right, let's talk a little bit about CUSMA. The trade deadline's fast approaching. What are you bracing for? What are you looking for with this?
Yeah, it's been interesting over the last 5 months. I've had a chance to tour across the province and talk to a number of clients, both here in Alberta and down east. And the CUSMA is something that's definitely on people's mind. I think when you look and reflect, the trade and the tariffs that were talked about last year has helped in a number of ways prepare clients for this uncertainty. But with the deadline looming, to your point, it's definitely on the mind of a lot of clients. I think for us, the biggest thing is clients take the time to fully understand what's happening and what's going on and make intentional decisions, whether that's waiting for sort of further results or what's going to actually happen, or even if it's a long drawn out negotiation. I think being very intentional is critical at this time.
And do you see it as a headwind, or do you just see it as something that's just part of the environment right now?
Yeah, unfortunately, it is becoming part of the environment. If you would have asked me that a year ago, I would have said it's definitely a headwind. But the reality is it's an uncertainty that clients have to work through. And like all uncertainties, whenever a business is faced with uncertainties, they're worried about making capital investments. And we're seeing that right now. A number of clients are hesitant around making capital investments. They're not sure what's going to happen with CUSMA. So they're patiently waiting on the sides. And what's really important for clients right now is to make sure that you're seeking advice, make sure that you understand what could happen. So when the time is right, you don't miss out on opportunities.
All right. And just talking about the Bank of Canada, there's been so much uncertainty with what's going on with that. How is that playing out for you? How are you balancing that?
Yeah, I think whether you look at the Bank of Canada, the uncertainty of which way they're going to go with interest rates and what happens there, when you look at unemployment and the impact of unemployment or capital investments, I think right now it's a challenging environment for businesses. And this is where businesses have to lean on trusted advisors that know and understand their business, that are expert in the sectors that they're working with, so that they can help them navigate this uncertainty, whether that's what's happening with interest rates, whether that's with CUSMA or other uncertainties that they're facing today.
Okay, Chris, we have to wrap it up there, but thanks very much for joining us.
Thank you so much. Have a great day.
You too. Chris Turchansky is president and CEO of ATB Financial. Coming up, we are unpacking Walmart's earnings and their forecast after the break. Rising fuel costs could mean higher prices at Walmart. The retail giant reporting stronger than expected results with revenue of $177 billion and earnings growth of 7.3%. Adjusted EPS came in at 66 cents, in line with estimates, but the stock fell in early trading on weak guidance. We're joined now by Jehan Ma, senior analyst, U.S. broadlines and hardlines retail at Bernstein. Thank you very much, Jehan, for joining us today. We appreciate it.
Thanks for having me.
Okay, overall, looking back wasn't bad for Walmart. It's looking ahead that has a lot of people concerned, isn't it?
I would say on the one hand, Walmart is always known for guiding conservatively, so this is not a surprise. I think it's widely expected that they're going to maintain guidance for the rest of the year, and it's a guidance that consensus generally views as highly conservative. Now, to your earlier point, the rising fuel cost is adding some added pressure on top of an otherwise fairly supportive consumer environment that we foresaw in the beginning of the year, and now that's changing somewhat with the higher fuel cost. Walmart did mention that from Q2 onwards, they're going to start to find efficiencies, and maybe retail pricing is going to start to increase as they try to pass on some of the added fuel cost pressure. So I don't think this is going to be a permanent headwind necessarily for the full year. But I think on the one hand, it's causing some concerns about, how much more can they beat their current guidance from here? And is there downside from consensus expectations? And second of all, of course, people are generally fairly cautious about the consumer environment right now. So the market has been fairly punitive of any less than perfect prints so far this earnings season.
It's been a good earnings season. With the gas, from Walmart's internal side, do they have enough power to even drive gas prices down when they go to fill up for their trucks and everything? The fuel expenses on their side. Do they have any leverage on that, or is it they're like everybody else, just along for the ride?
I'm sure there's scale advantage. I guess the difference is Walmart does own their private fleet for the inbound freight, which is from the distribution centers to stores. So I guess there's less of a bargaining power with the 3PLs from a negotiation perspective. It's more in the sense of, they're already generating a lot of cost savings from their private fleet. They sometimes buy forward by a couple of weeks to hedge the diesel cost, but it's not perfectly hedged. And so in that sense, are they exposed to rising fuel prices as everybody else? Yes, in that sense.
Okay. And then, of course, on the other side, the customer, if their money's going towards gas, they don't have money to buy things. Is there anything Walmart can do to keep people coming in?
I think they're doing a great job, frankly. Their share gains have been accelerating. This is usually the environment where Walmart shines on the top line from a market share perspective. Just look at the value proposition they're able to offer. Look at the faster and faster delivery speed they're able to offer. In this environment, I would say, if you look across the income cohorts, no doubt the low-income consumers have come under pressure the most, the earliest. They have not really benefited from tax refund as much. Some benefits have been tweaked or taken away, and meanwhile, gas prices usually impact their spending power the most. That's where Walmart's pricing power really stands out. And meanwhile, the middle to high income consumers, even though they have been more shielded by tax refund so far, that's a one-time finite benefit. So as they work through the tax refund benefit, if energy inflation stays higher for longer, I think that's likely going to drive more middle to high income consumers under pressure as well, and driving trade down to Walmart, where they stand out to be a beneficiary as well.
So they could actually, you think they could actually win with the higher prices in some ways?
In the
higher
grand
fuel
scheme
prices.
of things, yes. In the near term, I would say they usually say, we're the last one to raise price. We want to provide really compelling value proposition in times when our consumers are stretched. So in the near term, what we saw in Q1 is they didn't take pricing to adjust for the energy inflation. And as a result, there has been some margin hit to Walmart. So near term, could be some noise from a timing-wise. Their pricing actions will lag the actual inflation when there's a sharply rising inflationary environment. But in the grand scheme of things, usually they should be able to pass on the cost inflation, and they're still cheaper than everyone else, which means that they're gaining share.
Okay, and then let's talk about Costco. It's coming out the end of May. What are we expecting there?
Costco should be, I would say, one of or the biggest beneficiary from gas inflation from a top-line perspective, because not only are they cheap, their gas station, their actual gas is cheaper than most of the other gas stations you can find in the US, which means they're seeing a lot more traffic going into the Costco gas stations. And when gas prices are high, you probably don't want to drive to another store that's 5 miles away. You might as well just shop at Costco. And Costco will say in this environment, they'll convert sub 50% of that gas traffic into in-store traffic as well. Okay. So there's quite a bit of top-line benefit that they could be seeing. Of course, similar to Walmart, there's going to be a margin impact in terms of their supply chain cost, as well as Costco doesn't really make much money from a gas sales perspective. So there's going to be a margin mix headwind as well.
I have to wrap you up.
Broadly speaking,
I have to wrap you up there, Jean. I apologize. We're out of time. We're on a tight schedule. But thank you very much for joining us.
Thank you.
Jean Ma is senior analyst, U.S. Broadlines and Hardlines Retail at Bernstein. A $1 billion bill is heading to Canada for the World Cup. CTV's Andrew Johnson has more.
With the transformation of Vancouver and Toronto into World Cup cities just about complete, excitement is building.
I think it's great to see the festival here and all the games and everything coming into town. Money well spent.
A cost that's now eclipsed $1 billion, according to Canada's budgetary watchdog, to host 13 games in June and July. That's roughly $82 million per game, which is actually less than Russia spent to host in 2018, Brazil in 2014, and South Africa in 2010. But one sports economist points out co-hosting alongside the U.S. and Mexico, what we're paying for doesn't quite compare.
We're not getting any of the major elimination matches. We thought that if we were hosting the World Cup, we would actually see something of consequence.
Close to $500 million for FIFA is coming from Ottawa, the rest provincial and local, to pay for security, infrastructure, and stadium upgrades. The host cities are counting on a big benefit. BC's premier says the tournament will bring 1 million visitors to Vancouver over the next 5 years. The mayor has led the charge.
This is an amazing opportunity. It's going to be a month-long commercial.
Critics claim otherwise.
I've been saying for 8 years now, give or take, that we were sold a false bill of goods, not by FIFA, but by our politicians.
How do Canadians feel? Well, the latest polling from Leger showed close to 3/4 of Canadians support hosting World Cup matches, but a majority indicated their biggest concern is taxpayer costs. And the final number isn't in yet. Andrew Johnson, CTV News, Vancouver.
And thanks for watching Morning Markets. I'm Roger Peterson. We'll see you back here tomorrow. Market calls up next.